Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for the segment, we have Paul Baiocchi, Chief ETF Strategy at SS&C ALPS, to discuss why active versus passive management is a very important debate for real estate, considering the importance of valuations in the sector. Paul, it's great to see you as always. Welcome back to Trade Talks.
Good to be back. Thank you.
You got it. And real estate has been one of the worst performing sectors in the S&P 500 year to date. What are the factors that have led to declining performance, and what variables should investors consider as they evaluate the sector heading into 2023?
So if you look at real estate and REITs, publicly traded REITs specifically, historically, they've tended to go up when interest rates were increasing, but the exception to that has been in Fed tightening cycles. And if you look this year at the aggressive nature of Fed policy, at least the hawkish nature of Fed policy so far, it's no wonder that, at least in terms of historical precedent, that we're seeing REITs decline in that Fed tightening cycle. Now, as we true up our exposures at the end of 2022, the question is, well, what is the pace of Fed hikes likely to be into 2023? And are we near or at the end of the Fed's tightening cycle? And from that perspective, I think you've got investors who have underwater REIT positions, perhaps in an index strategy, people who might be overweight the commercial property sector within the real estate sector, who are feeling the pressure on commercial real estate valuations as a result of both increasing interest rates and, of course, this ongoing evolution of a hybrid workforce or more remote working. And so when you add it all up, it's certainly the Fed's hike posture so far in 2022 that's weighed on the real estate sector and REITs in general, but it's also within the REIT sector, different dynamics impacting different segments, whether it's commercial versus tower REITs, data center REITs, etc.
Yeah, and we'll talk more about that, Paul. I want to speak about the future of work and the corresponding shift to the hybrid workplace. How has that impacted commercial real estate investment opportunities? And then what are your thoughts about hybrid work longer term? Is this something that the commercial real estate market's going to have to learn to live with?
I think it is. I think we're in the early innings of companies rationalizing their commercial property footprint and trying to determine where they want to have space and the demand for space from workers who have gotten a taste, if you will, of remote or hybrid work and are looking for companies that will provide them the type of flexibility that they've come to know over the course of the past couple of years. So in that context, I think it's important to understand that we really haven't seen massive revaluation downward of commercial property, at least in the public markets, to the extent that we might over the course of the next few years. And it's important to note that there's various municipalities that depend on the revenue base derived from commercial property. And so there's knock-on effects of this transition to a hybrid workforce or a remote workforce. But long term, I certainly think that companies who are able to provide flexibility, either in the form of outright remote work or hybrid work, are going to be able to generate and attract the type of talent that they need. But also, companies that have commercial property portfolios are going to have to determine what type of commercial real estate is going to be in higher demand relative to other pieces of property, locations, benefits, amenities, etc., are all going to come into focus. And I think it underscores the difficulty in simply being passively invested in the public real estate market and perhaps leaning on an active manager who can determine relative valuations in the category.
Yeah, I mean, the thing is, too, when it comes to commercial real estate, it's not as if you can just flip a switch and either move your HQ or dissolve your assets there or, right size your office. I mean, it takes years for this to play out within the sector. So with that said, what segments of the real estate sector stand to benefit from this shift?
Well, if you look at, say, the real estate segment of the S&P 500, so the sector as defined by GICS, you have a lot of tower companies and data center companies within the REIT structure at the top end of that cap weighting. And I think those companies are less sensitive to this shift from remote or from in-person work to remote work and actually stand to benefit from it because, in theory, if you're going to have more remote employees, you're going to have more demand for cloud-based services, security, et cetera, and the infrastructure required, which, of course, has been a boon in demand for data center properties. If you think about it, the rollout of 5G nationally Certainly that's been a benefit and will likely be a benefit to the tower companies going forward. So within the real estate segment, those segments are perhaps insulated from this readjustment or revaluation of commercial property, but on the other hand are also very beholden to tech spending, enterprise spending. And so when I said earlier that there's different economic dynamics that impact different segments of the real estate segment, that's certainly true when you think about the nature of real estate here in 2022 and going forward into 2023. The other point I think that's important to note is if you look at private property markets, they've held up much better than have public property portfolios. So publicly traded REITs have underperformed their private counterparts. And if you look at REITs broadly in the public space, they trade at an aggregate discount to net asset value. And historically, that's been an indication of potential outperformance. So I think distinguishing between private and public, we saw a note from Blackstone recently that they're going to halt redemptions on one of their private real estate strategies, and investors are probably looking for alternatives to their private property portfolios. And publicly traded REIT portfolios, indexed or actively managed, do give them an alternative to some of those private benchmarks.
Right, and certainly more liquid too, I would imagine. Paul, why do you think there was that divergence in performance between private and public?
Well, some of this is just the nature of pricing public property on an ongoing basis, like you mentioned, in a very liquid marketplace versus the slower cadence or the less frequency in valuing private real estate. That's always going to be a distinction between the two and lead to performance deviation. But ultimately, there's a stickier nature, to your point, to assets in the private market. And so from a creation and redemption perspective, given the liquidity of public REIT portfolios, it's easier for investors writ large to liquidate those positions when they're trying to raise cash or they're reallocating in their portfolios.
Yeah, it certainly is an interesting sector to cover, Paul. We appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.